markets can. Stock markets have a far greater probability of giving 100% returns in 3 to 4 years than actually real estate. Real estate, we were setting a benchmark of 5 years. Gentlemen, I have to take a break. I will come back. Harsh, just one comment from you after this break, a wrapping out one between these two asset classes before we let you go. All right. If you have a stock market storm, then do you start actually being thankful that you have a hard asset like real estate in your investment portfolio? We've seen last 3 years, stock markets have been in a bull run, but real estate hasn't gone anywhere. So that's the question we're asking our panelists today. Rohit Raj Modi, very quickly, I know you were trying to make a point here, but I think the broader point which is coming out is real estate is not a bad investment at all. It's actually done very well for the retail investor. It's just that stock markets have the potential to outperform real estate in the coming years.
No, the point that I was making earlier also, and I'll give you an example. It's not about a developer's IRR, as somebody said. Let's take an example that 1980, a 1,000-yard plot in GK1 was for 5 lakh rupees. Today it's for 50 crore rupees. Recent memory, 2005, I sold apartments in Indirapuram for 10 lakh rupees. Today they trade at over 1 crore and 20. So real estate, if you look at a 30-year history, has outstripped securities and equities. I'm not saying that you don't have equity, it's a basket. You must have a balance in that. But real estate has been an outperformer in a long term by far. And obviously it's a far more simpler instrument to invest in as compared to stock markets, which are usually risky for a common retail investor that we are talking about. The only way for a retail investor is to go through an SIP so that the risks are mitigated and to look for a 12 to 15% return on an average over a 10-year period, and that's a healthy return according to me.
All right. Okay, before I toss to Harshroongta, let's just take a look at what's happened. Like Harsh said, you can't really look at real estate as the shelter because there is gold that you should be looking at as a shelter. Well, when we did a debate last year at Diwali, we had gold 10-year performance at 17.5%, 5-year 14%, 3-year 11%. Now that I'm sitting with data, 3 years has turned negative 4%, 5 years has turned 7.5%. If you look at what's happened to the BSE Sensex, well, we got the data, 3 years is 13.5%, 2 years is 18%. And when I was doing the debate in October 2014, 1 year was 26%. The returns had become so phenomenal, and 3 years was 16%. Now, what's happened to real estate markets? We had a Gurgaon, I'm not going to take too many figures, but Gurgaon, which was actually at 18%, which has now come down to about 11% of returns. So the point that I'm trying to make here, Harsh, and I would like your opinion on this, is that there is no asset class which will outperform the others in any given period of time. The asset class outperformance will keep changing. So how does a layperson, let's take like above than median income, because anybody who's earning about 10 lakhs in India can only afford to buy a home to live in. They can't even look at real estate investment. But if you can move into the bracket of being able to afford real estate as an investment, how will you balance that portfolio today?
So a quick look at what should I do in my portfolio. I think everybody in this panel agrees that the portfolio, if you can afford it, should include debt, it should include gold, it should include equity, it should include real estate, in my view, if you have a large enough portfolio.
Okay.
Clearly, as a certain percentage. So balance, I think, is key. The key and the other discussion point really is what percentage should real estate be versus, let's say, an equity.
Right.
And I think my point to that is very simple. I cannot take an example of a stock of, let's say, a Wipro or an Infosys that was 10,000 rupees. If I invested 10,000 rupees in 1980, that's worth 630 crores today. I cannot use that as an example to say equity is good. I think what you really need to see are 10-year moving averages of the indexes. In the equities, that data is very easily available. You can actually get representative index data. Now, with real estate, data has always been a problem, and we're reduced to going back to looking at anecdotal data on a specific product, on a specific plot, on a specific, that way any one equity that's turned 1,000 times, and there will be plenty of examples of shares that have grown 1000x. But that I cannot use to say equity is better than real estate. So I think the point really is, I really want to question the fact that it is not simple to get into equities. In fact, getting into equities is much simpler than getting into real estate. Think of all the pain that you have to go through to book a property or to buy a property versus buying a share. More importantly, selling. When was the last time you heard that equity became zero? Even in a down market, there is liquidity for your equity. In a market like this, where is the liquidity for your real estate? You can't sell it even if you want to give it away free. I mean, I am exaggerating to prove a point. So the point really is, I think balance is key. And for a retail investor, I would suggest very strongly that that balance should lie in favor of equity and debt, of course, and gold, and a little bit of real estate.
Let's bring in the other speakers as well. Sometimes all the arguments you've been hearing, Ghulam, for people who are actually only paying upfront 10% of their of the down payment and leveraging 90%, double income families or high income families, for them literally real estate today becomes a debt product. If you're going to have a 50% equity and 50% debt, can you consider real estate as more a debt product in their portfolio? Is that a good consideration or no? It's a flawed argument.
Well, this is definitely a flawed argument if you look at it from a wealth manager's perspective. However, that has been the beauty of real estate. When we're talking about so many of other alternate asset classes, where else do you get a home loan or a mortgage, etc.? And this is exactly where a few of your blemishes on your real estate tend to be covered, because you're getting easy money through mortgages and also the income tax benefits and so on and so forth. So lots of these things are there which make real estate slightly more exciting than the rest of the asset classes. And as I said, it's only for these small initiatives or small plus points would I still invest in real estate. Otherwise, if I look at a sheer return, I don't think there is much remaining in today's real estate market.
Amrish Balika, I've never understood this question. People say, in fact, you had Wall Street Journal after the Dow's crash saying that, in fact, the title of today's discussion is borrowed from Wall Street Journal's article, which says, is housing a cushion or a shelter to the stock market storm? It's not just in India. Globally, this topic comes up anytime that you have a big historical meltdown. And you have HNIs who say, look, without investing in real estate, we would not have got richer. So what are we missing here? And yet we have an argument which is tilting towards equities and not real estate.
See, I think it's only a psychological shelter, because possibly the real estate prices don't really crash, or at least it hasn't crashed in the near past, at least in India. I'm talking of India, like the stock markets. So when the stock markets crack, at least you can look back at your real estate and say, okay, that's not cracked, that's still there. But again, the main question is liquidity. The sort of liquidity which is there in the stock market is clearly not there in real estate. Just like he just said some time back, that even if you want to give it for free, there is no buyer.
There's no buyer even if you want to give it for free. I think that lumpy, I don't think anybody who sells their property for free. Okay, gentlemen, so then let me just come to Kuldeep. I mean, you've been hearing this conversation. If I look at the argument of equities and say, make it really simple, do an SIP in mutual funds, the returns that I'm looking at are just mouth-watering. I mean, you don't have to get into the stock game at all. You have large cap equity funds, which have actually multi-cap equity funds. I'm taking multi-cap here. 2 years returns have been 35%. 3 years have been 21%, and 5 years also have been pretty good at 11%. So somewhere, do you think that Indian retail investors losing out by not looking at equity and parking too much trust in real estate?
Manisha, the question, the example that you've picked up is very interesting. But I'd like to